Hello, good afternoon, everyone. Welcome to the day 31 of our 60-day rule-based trading challenge. And today was a roller coaster day. We had a challenging day, but thankfully, gracefully, we were able to close the day in a positive territory. Uh, but the learning is immense today, I would say. Like with the VIX shooting up, with the geopolitical tensions heating up. The market was highly volatile, and especially the second half of the direction got completely changed today. And how our strategy handled it is quite interesting. And also the relevance of VIX in the trading is very important to understand. And this is a second instance where we got a setup of stop and reverse trade. And also on the reverse trade, we instead of going in for the short, we had to go for a long, meaning buying instead of selling because the VIX was going up. So it will be interesting to see how the day progressed. And let me share the screen. Uh, okay, so the trade which got triggered at 10 o'clock today. So again, because morning it had a little volatile environment we experienced. So our trade setup got formed at around 10 o'clock. So upon completion of the third 15 minutes candle, that is at 10 o'clock, once the candle got closed, we had to take the trade. So we took the trade at 10:02. And we sold the 24,700 put, hoping the market or rather the strategy had indicated as per the whatever the setup it is being defined, it was indicating a bullish trade, and indeed it was actually in a kind of favorable territory for till 1 o'clock or so. As you see in the chart over here, they have divided this chart into two parts here. One is the premium chart, and on the right side the Nifty chart itself, and you see here up to the afternoon or so, it was range bound. Basically, we had sold it over here, and then it was not really moving any direction. So it was helping us in terms of the premium decay here. That is why we were in most, for the first half of the day, we were in a profits. But suddenly, as you see here also on the VIX chart, it was actually range bound. This is where we had sold, and we had entered our short entry. And for most part of the day, it was sideways, so that the premium was decaying accordingly. And then over here, this is an important. So this I just kept the Bollinger Band as it is, so that as soon as the Bollinger Band got challenged, it started shooting up. And this is the candle which gave an indication that VIX is likely to shoot up. And that is the point also when as you see here on the Nifty, this is our entry candle. This is the entry candle, the one which is highlighted in the rectangle here. And the previous to that day low is also marked over here in the red line over here. As soon as the day low is breached, and as you see, this is the candle closure. The candle got closed, and that is when we go into a stop and reverse because we wanted the market to go up in the bullish side, but it didn't do. It started going against, and we will exit at 50% stop loss, or whenever it breaches our ORB, that is opening range breakout. So then we will exit there, and we will also take a stop and reverse trade. That means we take the opposite direction of trade on which we were earlier taken the trade. So here the trade was on a bullish side. That means we had sold the put. Here we were to sell the call basically. So, but the point over here is since the VIX was not in, it was on a rise. When the VIX is rising, selling option is not a good idea. So we just wanted to encash because the premium starts shooting up instead of the normal decay, which otherwise happens in a sideways market or when the VIX is dropping. So since the VIX was on a rise, so as per our strategy criteria, we entered a long trade here. So we exited here before even our actual 50% stop loss got triggered. Since the stop and reverse got triggered over here, we exited the trade, the short trade, and we went in a long trade. and we work for a small profit here. That is, we want to cover the cost. The first trade we lost some money, right? Like our aim in the second trade is always, as per the risk management, we just want to potentially we want to cover the cost. Obviously, here also we will put a stop loss, but this time we will we put only the 40% instead of the earlier 50%, because we cannot lose 100% in one day. It becomes very difficult for the capital or risk management perspective. So here, the since we could cover the cost and the made a marginal money over here, we had to exit. And what happened here also, practically, I will show you the scenario over here. So we had entered the first trade at 80, shorting at 80 rupee 65 paise, and the second trade, which we covered it at 100 rupees 90 paise. As you see, the quantity is 150. That means 75 more quantity we went long over here. And then, since our cost and the profit, marginal profit was seen, we wanted to exit this trade at 1:39 p.m. My order got rejected because there was a shortfall of the margin, and then I was wondering how come the shortfall of the margin. Then I realized I had not closed the earlier stop loss order. The earlier stop loss order was still existent. That means there was one more shorting order was pending. So that is why the margin was coming shortfall. So immediately I canceled that as soon as I realized this at 1:39 and 5 seconds. And we canceled the second order, the open order, and then exited. By this time, it went in further our favor, like say 124 to 131. So that is how, as you see here, or although the intention was to make a small, cover the cost and make a little money, but it ended in a reasonably good money also, the profits as such, because of the slippage. And of course, it would have worked in the other way. So it is against our, I should ensure that the only learning over here is I should ensure that the stop loss order, before placing the exit order, I should have ensured that my stop loss order is earlier stop loss order is cancelled, and then only I should have attempted to exit the open trade. Although it worked in my favor here, it is not necessarily always like that. It would have worked in the against our favor also. So it is better to stick to the rule. So it is the deviation which occurred here on this today. So again, coming back to the trading law. So it is basically, we first trade is at 80 rupees 65 paisa we entered, and 100 rupee 90 paisa we exited, and then a trading cost of 59 rupees, which means we incurred a loss of 1577 or 1576 or so. And then the second trade we went in long, and it is long at the same the price at which we exited. There's 100.9, and 100.9 is the entry price, and we exited at 131 rupees. We incurred a trading cost of 64.60, and then we made a profit of 2196 over here, and that resulted in a equity, the equity curve going, it took a dip today for a while, and then it went up here. So we are now standing at peak level again for the third consecutive day. We are at a peak level at 12.45%. And yesterday I had mentioned, generally after the four winning streak, statistically the fifth win is bit challenge in this strategy. When we're looking at my backtest results also, there are some six winning streaks in the backtest results. It's not that it's the highest, but majority of the time after the third three winning streaks, or the four winning streaks, it generally takes a loss, and it maintained that statistically correct picture over here. So this is one loss here, and then again one profit. So it is not about again the profit or loss, but just wanted to show how important is the statistical points also when we are executing the strategy. So that's all for today, and thanks for your continued support. And we are in a very healthy position after 31 days. So hope we will be able to maintain this streak going in the remaining days also. So, bye bye and take care. Have a great evening.